Drew Matus is here for more. He's the chief market strategist at MetLife Investment Management, here on set with us. Do you want to jump into this debate over, do you perceive that, yes, in largely speaking, we're not seeing a lot of pass-through on the inflation front, which means that foreigners are eating the cost, some importers are eating the cost, corporate margins are taking it somewhere. Just what's your macro thought about what we're seing?
Well, I think that's right. I think that, it's getting eaten in a lot of different places. It's not showing up completely on the consumer side yet. Right. Everything takes time. And, if there's the potential for pricing power, firms will exercise it. If there is too much margin compression, they'll cut back. So I do, I'm kind of more in the Waller camp. Like, we're going to see it, but it's going to be a temporary feature because it's just going to boost prices for a year. And then the trend rate and price appreciation or price growth is going to go right back to kind of the 2 to 3% rate that we're seeing. I don't think there's going to be a spiral higher in prices.
We need a bell to ring when I think somebody nails it, like ding, 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 because I think you just absolutely nailed it, Drew. And we would expect nothing.
I'm sure we could get that sound effect.
We need to have it. Call Kramer's office. We'll go ding, ding, ding. But because the hamburger went from $15 to $20. So you have a 25% jump in inflation rate on the burger. Then it goes to 21. Well, okay, that's a tiny jump. But it doesn't mean the burger's cheaper, right? It went from 15 to 20, then 20 to 21. So the inflationary effect is much smaller. I feel like, to your point, the tariffs will do that. And others I've talked to say, well, I'm going to have to raise prices a little bit. And then that year-over-year number that we always like to cite, 3%, will be baked in. Are you saying that tariffs are kind of a one-year or one-time phenomena?
You don't want to be raising prices every month. So you want to basically get your price increase. You want to know what that price increase should be, and then you want to execute on it, right? And so maybe you're willing to actually take it on margin for a little bit until you figure out what actually the full price effect will be, and then you determine how much of that to pass.
You take the medicine now.
Because
or the consumer takes.
You want to make sure that when you put through the price increase, that it's sufficient to cover your increased costs, right? Because you don't want to do it. You don't want to raise prices last month and then raise them this month again and then raise them next month again. Because for the consumer, they're like, wow, this person just keeps raising prices. Whereas if you just do it once in kind of the shock system, then they just see the one-time price change and then it.
Okay, I'm sorry to belabor this point. Is there and I'd love to hear the audience can tweet at you, Kelly, or me if they're nice. On how they feel about it. Because if the burger goes from 15 to 20, they're aggravated. They're annoyed, right? If they really want the burger, they're going to pay the 20. They're not as annoyed when the burger goes from 20 to 21 because it doesn't feel as painful, even though it is a lot more expensive than it used to be. But I believe economists have a term for this.
But if you add up the level of annoyance, it would have just been better to go take the burger from 15 to 21. And then, hey, we're not raising prices again. And then 3 months later, everyone forgets that the burgers were $15 to begin with, and you're off to the races. The other thing, too, I mean, it's funny, and this isn't related to tariffs, but, all those credit card surcharges and things like that. I mean, that's not showing up. That's not in CPI, right? The fact that, every time you go to use your credit card now, you have to pay a couple extra percent, or carry around a load of cash.
Yes, which is what now I often, I better have cash on hand. Some people, they now have signs where they say, we're actually marking it up more than just the pure price of what we charge the credit card company, which I thought was interesting.
Well, what's amazing is that there's a price to actually transacting in cash, right? You can lose cash, you can get stolen. There's lots of things that go wrong with cash, and yet somehow that doesn't get deducted. And anyway, that's my little rant right there. Is that there's a lot of different price things going on right now. Tariffs are one of them. Some of the other things.
I don't think it's a rant at all. I don't know about it. I'd love to hear our viewers. And I understand that we live in more expensive areas, and so whatever. More people than ever in my life are asking me to be paid in cash. Do you find that true, Kelly?
Yeah, absolutely.
Right? I mean, I'm not talking about
asking or you're
smaller things. I'm talking about big things.
Yeah.
Yep.
Paint my house. Well, here's the cash price. Like, bro, if I pay you in cash, first off, I don't have a bag of cash laying around. Secondly, you're not going to pay taxes on that, which is just going to ultimately come back to me. Then they walk away. It's actually a fascinating inflationary, or would that be deflationary or disinflationary? I don't even know what these words mean anymore.
I don't know what it is. I just know that it's becoming increasingly frustrating to try to buy things. And actually, you saw that in the Beige Book today, right? They were talking about how consumers are pulling back. There was a rush to get ahead of the tariffs, right, with autos and things like that, and people cut back on everything else so they could buy the new car. And now they're rotating out, and it's not clear that they're going back and rotating back into the services and other goods in the same pace. If firms were seeing that this activity is going to continue, you wouldn't see the weakness in the labor market, because firms are smart enough to realize that they need to hire now if they think demand is going to be stronger in 3 months. And so I do think that there's a decent amount of, there's not a huge amount of weakness now, but there are the hints that things are kind of slowly grinding a little slower. And I think that that's something that we ignore at our peril.